Don't fight the Fed. For almost 20 years, that's been the most reliable rule in markets. Every time stocks fell hard enough, the Fed roped to the rescue. Cut rates, printed money, caught the fall. Traders even named it the Fed put, your safety net. Last week, that net got pulled away. There's a new chair running the Fed, and instead of the cuts everyone expected, he's signaling the opposite, a hike. His priority isn't your portfolio. It's killing inflation, even if markets bleed. This is the biggest shift in markets right now, and most people are still trading like the old rules apply. And if you want markets explained without the hype, take a second to like and subscribe. It genuinely helps the channel. The whole story starts with one man, the new Fed chair, Kevin Warsh. His resume is the twist. Warsh sat inside the Fed during the 2008 crisis as its main link to Wall Street. When the banks were collapsing, Bear Stearns, then Lehman, he helped run the rescues. He helped build the bailout machine. Then, in 2011, he quit in protest because he thought the money printing had gone too far. So the man who helped save markets walked away when the Fed got hooked on easy money. Now he runs the whole thing. His message boiled down. The Fed has missed on inflation for 5 years and he'll fix it, even if asset prices have to fall. The old rescue reflex is dead. Sound extreme? It's happened before. The last chair to put inflation first was Paul Volcker. In the early 80s, he jacked rates to 20% and forced a recession on purpose to break it. Warsh keeps invoking Volcker's name. That's not an accident. And there's a reason he chose this. Easy money pumps up stocks, crypto, and home prices. Great if you own them, but it also drives up rent, groceries, and insurance, which hits everyone else hardest. Warsh is choosing the price of eggs over the price of your portfolio. That's a real shift in who the Fed protects. Start with rates. The Fed is holding at 3.5 to 3.75%. Expensive money, and it's staying that way. Look at the Fed's own forecast, the dot plot, a chart of where officials see rates going. It now points to a hike this year, not a cut, a hike. Why? They just raised their own inflation forecast to 3.6%, nearly double their 2% target, and the market finally believes them. A month ago, traders saw a 1 in 4 chance of a hike by year end. Now it's 3 in 4. They flipped from betting on cuts to bracing for hikes. Some go further. Bank of America now sees 3 straight hikes, taking rates toward 4.5%. A year ago, the debate was how many cuts. Now it's how many hikes. So what does higher for longer do to markets? 2 things. First, safe cash starts paying. A treasury bill at 4 or 5% now competes with stocks and crypto, and the bar for taking risk jumps. People are already moving. A record $8.3 trillion is parked in money funds, just earning yield, the biggest cash pile in history. Second, high rates hit the most speculative stuff hardest, high-flying tech and crypto. Tighter money pulls valuations down, not up. That's not a forecast, just the mechanics. But wait, didn't the Fed just end QT? It did. And that's exactly where people get fooled. Or QT, quantitative tightening, is the Fed shrinking its balance sheet, pulling money out. It stopped in December, so everyone assumed the pressure was off. But stopping isn't refilling. The Fed still sits on $6.7 trillion. It's unwound only half its pandemic pile. It stopped draining the pool. It didn't add a drop back. So the easy money everyone's waiting for isn't coming. Not making things worse isn't the same as making them better. Now the part almost nobody's watching. The system used to have a shock absorber, a facility called reverse repo. Picture a parking lot where money funds stashed spare cash at the Fed. Over $2.5 trillion at its peak. That lot is now empty. For years it soaked up every shock, every wave of government borrowing, every quarter-end crunch. Now the next jolt won't hit a cushion. It hits the banking system's cash directly. You can already see the strain. A key funding rate, SOFR, keeps pressing against the Fed's floor, the signal that cash is getting scarce. No crisis yet, but the warning light is on. This is bigger than America. The same month Warsh signaled hikes, the other giants moved too. Europe's central bank raised rates, its first hike since 2023. And Japan, the world's last source of free money, hiked to 1%, its highest since 1995. The Japan move is the sleeper. For decades, investors borrowed yen for almost nothing and shipped it worldwide into stocks, bonds, crypto. It's called the carry trade, roughly $4 trillion. As Japan hikes, that money gets called home. And we've seen this movie before. Back in August 2024, the Bank of Japan raised rates just a quarter point. That tiny move snapped the carry trade. And in a single day, Japanese stocks crashed 12%, dragging the S&P and crypto down with them. That was one small hike. Now they're going further from higher levels. So it's not one country tightening. It's all of them at once. The global tide is going out together. And there's no easy central bank left. So here's where we are. For almost 20 years, the move was, don't fight the Fed, because the Fed had your back. Now it's the opposite. The Fed is not coming to save you. And here's the part that should really bother you. The Fed hasn't even hiked yet. It hasn't sold a single bond. On paper, it's done almost nothing, then money is already this tight. So if the Fed isn't the one draining the pool, who is? Something is quietly swallowing enormous amounts of capital, pulling it out of everything else. That something is AI, and that's the next episode. This was analysis, not investment advice. If it sharpened how you see the Fed, like this video and subscribe, and I'll see you in the next one.